Is the United States really the place to be right now? Is that the last place, the only place left with a real positive yield for us to pick up in corporate credit markets?
Hi, John. Yes, we do think on a relative basis the U.S. bond market makes the most sense right now, but we do want to be cautious because the reality is that credit risk is increasing. There's a lot of corporate debt outstanding, and so it does make sense that investors are going into credit markets, but you want to be a lot more selective and defensive right now. The global economy is slowing, monetary policy has limits, and we're likely not going to pivot soon enough to fiscal policy. And so the reality is that risks have increased a lot, so credit investors need to be more defensive and selective.
And perhaps in the short to medium term, Mark, you've also got to be willing to underperform. And I'd love your insight on that dynamic over at Pimco right now. You've been defensive corporate credit. Corporate credit has been where the performance has been. How willing do you need to be to underperform in the near term to avoid some of the risks that you think are on the horizon?
So, John, we actually like our positioning. We're most constructive on non-agency mortgages. We still are constructive on the U.S. housing market, particularly in the red states. We're basically owning REITs, which will benefit from the strong consumer, which you talked about, as well as the low interest rates. And we like cable, telecom, and the tower business. So clearly, yes, we have had a defensive bias, but we think that makes sense, particularly when you look in the context of a slowing global economy and the extended trade war with China.
So, Mark, what are the cracks you expect to emerge that haven't emerged yet? Where do you expect to see them?
So, Jonathan, I think we're already seeing them. I think if you look at the global economy, Germany is basically in recession. The manufacturing sector is below 50 in terms of global PMIs in many countries in Europe. It's slowing in the United States. We're looking at the U.S. Real GDP trending in the second half of 1.5. That's a significant deceleration from almost 3% last year. And we're likely going to see, as a result of this extended trade war with China, significant business and consumer uncertainty that we think will turn into a much more challenging environment for capital spending, which will ultimately then slow hiring. And those hiring trends, in fact, are slowing. So we think the warning signs are out there, and it's very clear investors need to adopt a more defensive posture, particularly in credit markets.
What does that mean for sovereigns then, Mark? We've talked about what it means for corporate credit. What does it mean for sovereigns after a massive rally through 2019? Do you want to lighten up there a little bit as well? And if so, where?
So I think if you look at this negative yielding debt, 15 trillion of negative yielding government bond debt around the world, you look at Germany, you look at Japan, negative rates, that, in our opinion, doesn't make much sense. We still think that these rates in the United States will be supported, given there is this huge need for income around the world. But in general, we think that you're going to see, maybe not cyclically, but over the next 3 to 5 years, a pretty significant shift from monetary policy to fiscal. That will lead to perhaps more long-dated government bond issuance and steeper yield curves. So the reality is that even in the bond market, investors are going to have to embrace more volatility ahead.
So, Mark, if I was to put you on the spot and say to you, where's the biggest risk right now, duration risk or credit risk, what would you say?
Say probably more credit risk, simply because we are very long in the expansion. The warning signs are clearly out there. We think high-quality duration will be supported, like municipal bonds, like treasuries, particularly relative to the negative yielding debt in Japan and Germany. But credit risk is going to ultimately have to face headwinds from a slowing economy, as well as shareholders who have been quite aggressive in rewarding equity. So overall, we think that defensive posture makes a lot of sense.
So, Mark, when do you start to get interested in high yield again? We're in and around 400 basis points over, out to almost 450 in the last couple of weeks. What kind of levels would you start to say, you know what, I'm looking at the risk and I'm saying that price actually does reward me for the risk I'm assuming? What kind of levels do we need to get out to?
So, John, I think the key thing is that we need the trade war with China to be resolved, and we're very skeptical it is going to be resolved. In fact, we think that President Trump is going to run a re-election campaign on being tough on China. And so this relationship between the United States and China is deteriorating. It's secular. I think the reality is that this will affect cyclical credits, trade-related credits, autos, retailers, chemicals, all these companies that are going to be at risk. They're not going to be able to pass on these higher tariffs. They're going to face rising costs. So the high yield sector will face more headwinds. We do not think the level makes sense yet. We would need to see much more concrete resolution in terms of the U.S.-China relationship, we'd also need to see a pivot to fiscal, and neither which we think are going to happen near term.